So welcome to this HKCBA webinar. My name is Diane Luo, and I'm Vice President of the Montreal chapter of the HKCBA. I will be your moderator for this panel. So today's webinar is Financing and Investing in Company Growth, Financement et Investissement dans la croissance des entreprises. This webinar will be held in English, but any interventions that you have, any questions, you can fill them to us in French. A little bit about the HKCBA. The Hong Kong Canada Business Association is one of the largest bilateral trade associations in Canada, with a mission to expand commercial relationships between Canada and Hong Kong, as well as throughout Asia, using Hong Kong as a platform for advancing this objective. We promote a strong business and community network within our membership across Canada through our programs. Let me first welcome our two speakers today. First, Brady Fletcher. Brady Fletcher is the Managing Director and Head of TSX Venture Exchange. He is responsible for optimizing client experience for all issuers and investors, as well as developing and implementing a multifaceted strategy to drive sustainable long-term growth. Based in Vancouver, Brady has spent his career in Canada's venture market with a specialized experience working with growth stage issuers to develop financing, M&A, and business development strategies. Brady's prior experience also involved advisory practices to early stage companies, and he was a founding member and CEO of a technology startup, Black Book Technologies. Welcome, Brady, and thank you for taking part in this panel this morning.
Thanks for having me, Diane.
Our second panelist is Richard Ho. He's a senior manager equity derivatives at TMX Montreal Exchange and has over 15 years of experience in the financial industry. Prior to joining TMX, he worked with a national brokerage firm in executing trades for active and high net worth individuals. In his current role as senior manager equity derivatives, Richard leads various education initiatives and partnerships with brokerage firms. His aim is to help self-directed investors adapt to the use of equity options with a focus on developing and strategizing options portfolios for directional trading with predefined risk parameters. And he will run through what this all means, of course. He also runs programs to show investors how to use option strategies to generate consistent income and to hedge their portfolios during times of high volatility, such as today. Welcome, Richard, and thank you for being with us today.
My pleasure.
All right, so let's start off with Brady. Give us a high-level overview, when and why should private companies, just before we start this, let me rewind 2 minutes.
Sure.
So for all attendees that are here, thank you for being here. And just for your information, we want this panel to be as interactive as possible. So you do have a little Q&A box on the top right corner of Zoom. And this is where you're going to be able to ask any questions you have for our panelists. What we'll do around the 11:30 mark EST is to switch into a Q&A format. And during the Q&A, we will be selecting 2 of your questions to ask to our 2 speakers. Does that work? All right, perfect. So going back to where I was, we are going to start off with a high-level overview of the topic with Brady. So Brady, when and why should private companies consider growth through public listing? Should any companies do it?
Diane, it's a great question. It's one that we hear a lot of, especially when you look at the headlines that go on in the US around the multi-billion-dollar IPOs and the Ubers and the Slacks and the Spotifys that go public in different ways. It is a really unique experience for a company to think about an IPO or going public. And traditionally, what that would mean is you would be a later stage company that had some stable cash flow revenue. You were institutionally relevant and able to attract all of the investment banks and could go through a very expensive roadshow with the legal work and the marketing to conduct your IPO. And it's true, and today that is what we see for the likes of Shopify and the leading large technology companies. In Canada, we have this really unique 2-tiered ecosystem, though. And that 2-tiered ecosystem means that we have the TSX, our senior market, which is which is a competitor to NASDAQ, to NYSE, to London, to all of the major exchanges around the world. And then we have the TSX Venture Exchange, which is what I had. And the TSX Venture Exchange presents this really unique platform for earlier stage companies to access what we call public venture capital. And it's a mechanism that is unique to Canada and heavily rooted in our resource industry. When you go back 20 years, we've always been very weighted to energy and to mining. And so the TSX Venture emerged as this financing platform that filled a void for these exploration companies. And as such, over time, we've developed regulatory policies, we've developed strategies and mechanisms like our capital pool company or reverse takeovers. And we've developed this retail ecosystem that likes to support earlier stage, riskier companies. Through that, it means that we can take companies either in the exploration phase for resources or those first phases of commercialization if it's a technology issuer. We take clean tech or renewable energy companies that are still pre-revenue, and we're able to help them get listed, and then access subsequent rounds of capital. And so when a company's thinking about going public with us, and I'll focus more on the TSX Venture side of things, generally we see if their market capitalization is somewhere between $25 and $75 million, that's where the investor audience seems to have the most attention for the company. And the really nice thing about going public earlier in a company's life cycle is that that company can raise a smaller amount of capital to go public, execute on their milestones, whether that's a drill program in Val d'Or, Quebec, or it's developing a new biotechnology and getting through their clinical phase 1. Once you achieve one of those milestones, then your valuation goes up and you're able to raise more money. And so that's one of the things that we really see on the TSX Venture Exchange is that companies come back to market and raise smaller amounts of capital in more rounds so that they can minimize the dilution to the company, as well as be able to build that credibility in public markets. And that's a really big thing, because when you think about that idea for a company to be able to build credibility in the public markets, to be able to start attracting the top US investors who all know how to trade companies up in Canada, it means that as that company grows and it goes from being worth 50 million to 100 million to 150 million, ultimately we look to graduate that company from the venture exchange up to the TSX, which is how our two-tiered markets work. So we help these companies access public venture capital on the venture. We help them grow, and then once they're at critical mass and they're institutionally relevant and we see the demand, then we help them graduate to the senior market of the TSX.
Thank you, Rady. And what are some strategies that these companies can adopt in order to graduate? Well, first to list and then to graduate.
Everybody hears about the IPO and the IPO process, and that is, by and large, the most well-known, cleanest path to going public. The IPO process is lengthy, and it takes time to prepare what we call a prospectus document, where you have to put all your financial disclosure, you have to put all your business disclosure, all the risks, everything about your management team into a very lengthy document that becomes your marketing document. And you can't tell anybody anything that's not in the prospectus. And so that works really well when it's an established business and you've got lots of clarity around it and you know what the valuation is going to look like. So you can get out with your bulleted prospectus and your investment banker tells all of the investors that you see that there's a range for the offering. When you think about the venture companies that are listing with us, roughly half of them go that route by doing a prospectus. The other half opt to do something more creative, and it's called a reverse takeover. So the reverse takeover can take two paths. One is, and what we have seen lots of over the years, is a reverse takeover of a junior mining company, for instance. And if a prospector went out in the Yukon and thought they had property that might have gold on it, and then they found out they didn't have gold, then that management team can tighten their belt and they effectively turn into a shell that's listed on the venture exchange. And that shell then goes and looks for a new company to vend into it. And what would happen in this reverse this reverse takeover mechanism is that the public company would find an interesting private company, and it will issue publicly traded shares to the private company in exchange for the private company's shares. So every shareholder in the private company gives their private company shares to the public company in exchange for public shares, and then the private company takes over running the public company. At the end of the day, you have effectively the same shareholder base, plus a couple that were on the public company originally, and now the private company is publicly traded. The really nice thing about this method is that at the end of the day, the public disclosure is the same. We require a filing statement, and we require a change of business document so that the public investors know what these companies are doing. But it gives a company and an entrepreneur the ability to back-end load their legal costs. And so they can get better certainty around the listing and better control over process by going through what we call a reverse takeover. The third mechanism that we actually have seen over 2,600 of in the last 15 years is what we call our capital pool company program. And the capital pool company program has been designed such that rather than waiting for somebody to go out and explore for gold and find out that there's no gold on a property, we can have a qualified management team put together a shell for the explicit purpose of trying to find a very interesting private company. And some great case studies for that are Wheaton Precious Metals, which started out on venture, graduated to TSX, now dual listed between TSX and NYSE, one of the largest companies in Canada. Canopy Growth Corp was one of the fastest to ever go from being a venture listed reverse takeover to all of a sudden being in the TSX 60, the largest cannabis company out there. And when you look at that, it was a small CPC that issued 100 million publicly traded shares to Bruce Linton to be able to acquire the Hershey factory. And that was the beginning of Canopy Growth Corp, a company that now does hundreds of millions of dollars in revenue and employs over 2,500 people. And the last point I'll make on that is that that's one of the big advantages to going public for companies like Canopy, is that in a dynamic new industry like cannabis was 5 years ago, someone like Bruce could be up and be public, have access to 12 different rounds of financing as he scaled the business, and also able to make 8 different acquisitions using his share currency. And so he was able to go out and issue those publicly traded shares to acquire more private companies, more of his competitors, and scale faster than anybody in the private space could.
Very interesting. Thank you, Brady. Moving on to Richard. I think that we're going to look at your side from the Montreal Exchange perspective. So what does the Montreal Exchange specialize in, and how does it fit into the TMX ecosystem?
That's a good question. Let me just put up a slide and show you what the Montreal Exchange does. So for those who have been long around enough, you'll know that the Canadian capital market was very different to what we know today. Back then, the TSX and MX had cross-product listings. So cross-product listings basically means that the Montreal Exchange was also trading stocks. That's why when I sometimes speak with these, brokers, they'll be like, "Oh yeah, the MSE." I'm like, "No, it's not the MSE anymore," because the MSE basically stands for Montreal Stock Exchange. But back in 1999, the TSX and the MX came to this agreement saying that they'll each specialize in an asset class. So since then, the Montreal Exchange became the only exchange operator for options and futures. And the TSX is the exchange for cash equity products, and like Brady said, IPOs for capital raising. Now in 2000, the Montreal Exchange demutualized. So what does demutualizing mean? It basically meant that the Montreal Exchange modified its ownership structure from a membership into a private shareholder model. So this being said, the shares of the Montreal Exchange were privately held by board members and the employees. Now in 2007, for those who remember, okay, the Montreal Exchange went public and it was officially listed on the TSX under the ticker symbol MXX. But 1 year later, in 2008, the Montreal Exchange merged with the TSX for $1.3 billion. And this is how the TMX group that you know today was created. So therefore, now we offer an integrated multi-asset class solutions for investors in the market. So that's a quick overview of the exchange history. But to your question, Dan, the Montreal Exchange really serves as a risk mitigator and also provides investors the options to increase or decrease exposure on any stock that has options listed on them within the TMX ecosystem.
Great, thank you. So walk us through our process. Walk us through our listing process of options. How does it work exactly?
That's a good question because, you know, going through IPOs, that's one thing, but options, we do it somewhat differently. Let me show you what I have here. Listing options is a different type of mechanism. When we talk about listing options, we have to talk about CDCC, okay? The CDCC is the Canadian Derivatives Clearing Corp. That's where the process starts because the CDCC is the entity that defines on a quarterly basis the list of TSX securities that are eligible for options. Okay, right now on TSX, there's about 1,600 plus stocks and ETFs listed on them on that exchange at TSX. And at the Montreal Exchange, we have about 300 plus option classes on these names on the Toronto Stock Exchange. Now, the CDCC, the Clearing Corp, they look at several metrics to determine whether or not the stock is eligible for options. So some of the metrics that they look at would be, for example, the public float. And also they look at the average daily volume for the last 20 business days. Now, all of these metrics, they have to be within the top 30 percentile. Now for ETFs, okay, or exchange traded funds, the criteria that CDCC looks at would be on the public float. That number needs to be greater than or equal to $20 million. That's for CDCC, but then at the exchange level, we overlay an additional set of requirements, such as the price of the underlying security, and then we also look at how volatile that security is over the course of the last 90 days. So this analysis, once that's complete, we narrowed down that list, and the listing committee from the Montreal Exchange will then submit these names to the market makers. Now, these market makers, they work for various companies, from approved participants to foreign approved participants. But then again, you have to remember that the Montreal Exchange, we have this competitive market maker model, where it basically means that for any option class that we list, we need to have 2 committed market makers. So market makers are there to put up a 2-sided market. Now for a 2-sided market, that basically means that the market maker needs to be there to show bids and offers at all times. So if we don't have 2 committed market makers, then that option class would not be listed. So this is how the listing process goes through for options.
Thanks, Richard. So thank you for walking us through this very complex system that a lot of companies are not aware of. Are there any resources available to companies that would want to have access to the TMX?
You mean in terms of equity or options?
In terms of options.
For options, for resources, I think the majority of the information would be in our circulars for companies who have any inquiries for that. They can Google our website, or this is the direct link. It's m-x.ca. Once you get there, go into circulars. That's a good place to get more information. Or there's a contact us. They can send us a quick email, and there's someone there gonna help answer those questions for them.
Great, thank you. So I see that there is there are quite a lot of attendees from all kinds of different backgrounds in our webinar. Again, we would encourage you to use the Q&A box. We want to make this webinar as dynamic as a Zoom webinar can be. So you are welcome to ask any questions you want. There are no stupid questions here. I think that we have great speakers today with us. Both Brady and Richard are very knowledgeable about their respective domains. So please go ahead and ask anything you want. And we will be selecting them in around at around the 30 mark, the 11:30 mark.
I'll ask Richard a softball question. So, you know, you're the investor and you're thinking about a portfolio. How do you determine when to use options, when to think about investing in equities? What would you talk to the average investor about?
That's a good question, Brady. Thank you for that. So the first thing that I always tell investors when they want to, learn more about options is like, start incremental. Like there's like over 30 different option strategies out there, and each option strategy serves for a specific purpose. For example, if you have a stock that you think that is going to go up, naturally you can purchase a call option. If you think the stock is going to go down, you could short the stock. But in many accounts, retail investors, they're holding their equity in registered accounts. For example, a TFSA or RSP account. In those accounts, considered as cash accounts, you cannot use margin. If you cannot use margin, then you cannot short the stock. But the alternative is that you can use a put option. So by knowing how to use options, it opens up the range of trading opportunities that you can use. It's like having an extra tool in your toolbox. Now, to your second point of your question, like when do you use equity and when do you use options? The answer is you never know. Sometimes you need to use a bit of both. Like for example, if I'm holding TD Bank shares, I'm receiving about 5% dividend yield per year. Let's say if I'm holding the stock, I want to generate additional income. What I can do is sell call options on these shares to amplify my return. It could easily boost my return depending on the option that I use to 10% per year. So it really depends on what your motivation, what your outlook, and what you want to achieve. Then you can define which option strategy to use.
Thank you, Richard. Great question, Brady. Thank you. We're going to be flipping the meta a little bit and look at so we look at the companies looking for growth. Let's look at both of these topics from the investor perspective. So Brady, what tips do you have to help investors identify growth stage companies in which to invest through the public markets?
Yeah, it's a great question. I saw Jeff posted it there. I think it can be daunting, right? When you look at between TSX and TSX Venture alone in Canada, we have roughly 3,200 listed companies. And so, as Richard mentioned about starting small and learning the strategies and learning about, investing in the first place, we have roughly $2 billion of ETFs, $200 billion of ETFs that are traded on our markets. And those can give investors access to a portfolio of stocks, whether it's Canadian technology stocks, whether it's cannabis stocks, it can be financials or high growth, or it can just be a typical index ETF. And so if somebody's just thinking about starting to invest and wanting to get their feet wet and look at some of the growth opportunities we have listed here, ETFs are a great way to do it. As you get more familiar with our markets, then the nice thing about public markets is that there's transparency to all of these companies. It's not like you're going to a crowdfunding platform where somebody has posted a PowerPoint and you're going on blind faith. We have done background checks on all the management teams. We're a regulated entity. I have 67 people in my listings and compliance team that are going through company filings and their public disclosure. And so all of that means that there's this huge level of transparency that's out there. And that gives investors confidence. It means that investors can now start saying, well, I'm interested in looking at mining stocks, for instance. And so then what you need to do is I would advise finding somebody in the mining industry that you might want to follow, whether that's one of the IR firms like Adelaide Capital, or it's an influencer like Ross Beatty or Frank Justra, somebody that you've seen has been successful in the space, and then try to find companies that they're involved with. Because what you're doing is you're betting on proven management teams. Most often, that's where we see the huge successes. You can look at the Great Bear Resources, you can look at all the things that have come out of Discovery Group, their track record of building mining companies that then get acquired. And so I would advocate really trying to find an influencer that you want to follow in our markets. The other piece that I would point people to who are just looking at trying to filter through these 3,200 companies is the TSX Venture every year publishes what we call our TSX Venture 50. And our Venture 50 is the top 50 performers of 10 companies in 5 different industry classifications, being mining, energy and energy services, clean tech and life sciences, diversified, and technology. And so if you look at our Venture 50 list that comes out at the end of every February, you can see a number of companies that have demonstrated not only just share price appreciation over the last year, but also market cap growth, which demonstrates they've been successful at being able to raise money and get engaged with the public markets. And I'd say that's a great spot for people to start looking at growth stage opportunities that are generally undercovered. And that's where I really think the most torque for an investor is if you can find growth stage companies that haven't yet caught the full attention of Bay Street and the investment audience. You can participate in that growth as they go from being worth $50 million to being worth $150 million when the analysts and the rest of the community start to pile into it. And, we do have TMX Money, which is a great site for people to be able to filter through and look at stock charting and some of the other basic screening tools that will help people find financing mechanisms and ways to get involved in these companies as well.
Thank you.
No problem.
Richard, on the same topic of investors, what type of investors are using options at the Montreal Exchange? Do they require any special permissions to trade options?
Well, at the Montreal Exchange, since we have futures and options, I'll first, get this off the discussion is, in terms of trading futures, it's primarily professional traders. So hedge funds, CTAs, institutional traders would be using futures. But on the other side, when we talk about options trading, that type of product is 50% of that trading volume comes from retail investors. And the other 50% is coming from institutional investors, professional investors. So anyone can trade options. It's very simple. All you have to do is speak with your broker and ask them to set up an options trading account. Now, because like I was speaking about earlier, in the options market, there are over 30 different plus option strategies. Some are, basic, plain vanilla, buy and sell calls and puts. But then after you can create these, what we call multi-leg strategies by combining calls and puts all together, long and short, to create, let's say, for example, condors, straddles and spreads. Then that type of strategy, you would have to get special permission. Your broker is going to sometimes ask you about your knowledge. What do you know about options? Do you know what the risks are? Do you have the credit approval? So they ask you about credit is because once you go into these, let's say, naked, uncovered writing call and put strategies, you need to have a margin account. So when you have a margin account, that means the broker is lending you money for those trades and you just put up a portion of it. That's why they need to do a credit check. So I strongly recommend, suggest to those who are interested in options, the first step to do is speak with their broker and say, hey, look, I want to trade options. How do I set up the account? And then they'll take you and walk you through the steps to do so.
Thank you. Members of the audience, this is your final few minutes to submit great questions to our panel of experts here. But I think one of the first things we want to do is to pick one of the questions that we have received. Let's see. So Andrew Yu is asking, both to Brady and Richard, are your exchanges affected by COVID-19 and how?
You want me to go first?
Sure, go ahead.
Yeah, there's COVID-19's definitely had an effect, but it's the reality of markets, right? And most recently, we saw the financial collapse in 2008, 2009. And when the financial collapse in 2008, 2009 happened, we saw a 9-month period where our number of new listings and companies coming to market decreased by about 50% for 9 months. And our financing activity slowed down by about 20%. And it was really interesting because in March, what happened with us was COVID-19 was going on in China and in Europe. And then through January, February, it kind of was starting to spread. And many of our team was at the Prospector and Developer Association conference in Toronto at the very end of February and up until March 2nd. All of a sudden, there was an announcement that there were 2 cases of COVID there. And so TMX said, hey, if you were at PDAC, stay home for the next 2 weeks and quarantine and make sure, or don't quarantine, just stay away from the office. And so I was one of those people. And so I was staying away from the office. And over the next week, we saw the spread of this virus and the global impact and the reaction and the recommendations from WHO and Theresa Tam and everything else across Canada. And TMX Group itself transitioned an 1,100-person organization with offices across Canada and into Europe and people down in the States and in South America. And we have representatives in Israel. We transitioned that whole 1,100-person organization into a work from home mode over the next week. And so it was that was a huge feat for us. But I would say that when you talk to our clients, we didn't miss a beat. And it's during times of crisis like this that it becomes increasingly important for our team to be able to be accessible, to be able to facilitate financings, to be able to facilitate shares for debt settlements. You look at what has happened across, companies big and small alike, the impact to their financial performance, the decrease in revenues, even up to the Canada Gooses of the world, that changes where these companies sit with their bank covenants. And so all of a sudden, a company that thought they had access to debt might not have access to debt anymore, and they might not be profitable this quarter when they expected to be profitable, which means they need to be able to come to market, access those investors that they have supporting them. And it's truly the equity markets that enable companies to survive and be dynamic and quickly access capital when they need it. On the flip side, for investors, it also means that, if you were a private company investor or a venture capitalist and you were invested into a brick and mortar retailer coming into March, it's very possible that your investment that you held on your books as being worth $100 million could be worth $0 today. And so the nature of public markets means that there's liquidity for investors. You have an ability to take in events, whether it's COVID-19 or something that happens with the Dow on a daily basis. You can take in those events and you can process it, and you can decide whether you want to buy or sell, whether you want to hold your stock or shift over to cash. And it gives you that liquidity that everybody should really look for.
Thanks, Brady.
So I would like to chime in. On the investment side, during the confinement, all the brokers have seen this increase in spike of new account openings. Trading volume has been increasing also as well. And people are taking, the time to re-educate themselves, to relook at their investments and their portfolios. Okay, what should the portfolio look like in the next 9 to 18 months? Because right now they're seeing lots of opportunities in the market where, lots of valuation in the previously overpriced stocks has been coming back to more reasonable valuations. They're also taking the time to self-improve. So they're going on to these broker websites to learn more about investment strategies. They're looking at webinars showing people how to use options. They're looking at webinars to show them how to use technical analysis. So I think there's bad things and also good things that turned out from this COVID-19 incident. but you always have to find ways to improve your investments by either learning, by modifying, reallocating your portfolio, and so on.
Perfect. Thanks, Richard. The next question comes from Bin Han. Are there any Hong Kong or Asian-based company traded at TSX or TSXV, and what are the advantages?
Sure. Today we have on the venture alone 1,700 companies, and of those 1,700, roughly 85% of them have Canadian headquarters, and the other 15% are international. As you might expect, we share the longest border with the US, very similar time zones. The majority of those international issuers are US based. We have historically had a large number of Chinese companies that did come to list in Canada. And over time, we've seen that number decreased, partly in the wake of Sino-Forest, that there seemed to be a little bit less appetite for that. More recently, we've seen a growth in companies around the world, and from Israel to China, from the UK to the US. We have Brazilian biotech companies that are coming to this market. And the advantage is that we have this two-tiered ecosystem. And that two-tiered ecosystem gives investors the ability to participate in these earlier stage, riskier companies where they can make much more money, but there is a risk associated to that. And it gives companies that access to subsequent rounds of capital. So they can raise that first $5 million as they go public, and then they can come back and raise 10 million once they've actually proven that next phase of their business plan. So we are out there, and we are speaking to many Hong Kong and Asian based companies. I would say, when you're talking to any company around the world, whichever jurisdiction it is, there's two key advantages that we have. The first is that we are unique in the stage of company that the TSX Venture services. Most people think about it as a Series A or Series B venture capital financing. And we offer this democratized platform where you can raise smaller amounts of money, earlier stage in your business, and you can grow as a public company in a right-sized regulatory environment where it's not Sarbanes-Oxley compliant. You don't have all the legal costs of being public in the US. The second advantage is that we share the same trading hours as New York, and you have to take into account that the US is the biggest equity market in the world, that their investors there have the risk appetite to participate in these companies, and that 25% of our daily trading activity at least comes from international sources who are looking to participate into these growth stage companies. So the Fidelities of the world are the biggest investors in the Canadian listed technology names. It's an easy hour-long hop up from New York to Toronto. Everybody gets to do the road shows. They have all the accounts. All the infrastructure is there for those US investors to participate in Canadian names. And it just gives any company from around the world access to a bigger pool of capital. And that's ultimately what you want when you go public, is how do you access the biggest pool of capital possible to be able to do those subsequent financings, finance the growth of your business. And Canada is a really efficient way to be able to access that.
That's a great pitch for Canada. Thank you. And for our final question, Alexandre Blais is asking Richard, why do options in Canada have such high commissions?
That's a good question, and it's a tricky one. Like the exchange, we have our own list of fees that we charge the brokers, and that list of fees is public, and anyone can have access to that list of fees. And what the brokers do is that they have to, pay for overhead, they have to pay for employees, licensing, and everything. That's why they tack on, a little margin on top of what we charge. What we charge at the exchange level is 50 cents per contract, okay, to the brokers, and then the brokers decide on what profit margin that they want to add on to that price. So what I suggest to you, Alexandre, is that shop around. There's like so many different online brokers out there. You have the Canadian bank-owned ones, you have the non-bank-owned ones. So look at the different options that you have there. No pun intended, but you're gonna you're going to be surprised that some of them do actually offer lower commissions than others. So I hope that answers your question.
Thank you. So this wraps up our webinar for today. Thank you, Brady. Thank you, Richard, for walking us through financing through the public markets, both from a growing company and an investor point of view. If you have any questions, I advise you for the audience to go on the TMX and TSXV websites. We thank the National HKCBA chapter and you, the attendees, for being here this morning with us and being able to converse and share the knowledge of our two experts. Thank you so much, Richard and Brady.
Yeah, thanks for having us.
And for anyone in the audience and our experts, the HKCBA also has upcoming webinars on international commercial real estate. You can find all of the information on our website. Thank you all for being here this morning. Have a great day.
Bye.
Bye now.
See you.